This presentation is on Chapter 13, Stockholders Equity. In the first learning objective, we're going to identify and talk about the characteristics of corporations. So first of all, what is a corporation? So in the United States, a corporation is going to be organized under state law, and it's going to actually be a separate legal entity apart from the owners, and that makes it different from a sole proprietorship or a partnership. Now, in the United States, corporations do dominate business activity because they are the largest businesses, and we'll talk about why that is in a later slide. So you would know the major corporations in the United States because you would recognize their names. Now, the most or the largest number of businesses are actually sole proprietorships, but they're much smaller businesses. So again, corporations are the largest, and so they have the most business activity. So what are some characteristics of corporations? As we talked about before, corporations are separate legal entities, and that just means that it's organized independent of the owners. It can conduct business in its own name. The other thing is corporations can have as small as one owner, but typically have many owners, and if they're public corporations that can trade their stock on one of the organized stock exchanges like the New York Stock Exchange or NASDAQ, they're going to have sometimes millions and millions of owners. But there are other kinds of corporations. They're called private corporations, and they don't trade their stock on a stock exchange, and they normally don't have as many owners. Now, one of the big pluses or advantages of corporations, which we'll talk about again later, is that the owners do not have any liability for the corporation's debt. So there's something called the corporate veil, and that just means that if a corporation goes bankrupt, then the personal assets of the owners cannot be seized to pay the corporation's debts. The other thing about corporations is that the individual shareholders can't bind the corporation to a contract. So that's what they mean by mutual agency. So if you have a partnership and it's a general partnership, a partner could bind the other partners and the partnership. So that is not something that shareholders in the corporation can do. Corporations also have indefinite life because if one of the shareholders were to die, the shares in the corporation can be transferred to another owner. Whereas like in a partnership, if one of the partners were to die, then that would make the partnership have to be dissolved. Corporations, since they are separate legal entities, are also typically going to be taxed depending on how they are set up under the tax code. If they're a C corporation, then they're going to have their own separate tax return and be taxed on their own earnings. One of the big reasons for being a corporation is that you can accumulate a whole lot more capital, and so typically when businesses do begin to grow, then they will do what is called an initial public offering, and that is when they first offer shares in the corporation to the public. And so that is the reason why corporations are so much larger, is because it's much more easier for them to accumulate capital. So we can see in discussing these characteristics of the corporation that there are advantages and disadvantages of corporations. So as we said before, corporations can raise a lot more money by selling shares of stock than are available to a proprietorship or a partnership, where they may just only have their own personal assets or what they can get through credit, so by borrowing money from banks. Also, as we said before, corporations do have that indefinite life, so they can continue on after a shareholder were to pass away. It would not affect the corporation. They could continue to operate. And also, like we said, you can easily transfer the ownership by selling your shares. Now, it's a lot easier if you're a public corporation. You can just go online and sell your shares or buy shares in a corporation. But private corporations typically are not going to trade their shares on the stock exchange. That would be a little bit different, but it would still be easier than selling a partnership interest. Again, you can't bind, one stockholder can't bind the other stockholders or the corporation, so you don't have to worry about people running around and getting the business involved in contracts and things like that. And the stockholders have limited liability, and that's huge because one of the things that you worry about when you're in business is if there were a lawsuit against against your business, and they got a judgment against the business and it was a sole proprietorship, they could seize your own personal assets, whereas for a corporation that's not true. Disadvantages, again, if you're a shareholder, you don't typically get involved in the day-to-day management of the corporation. You do have a vote to elect the board of directors who are supposed to represent your interest, but you're not going to be able to go into a corporation if you're a shareholder and start telling them what to do. So that does represent a disadvantage. Also, as we said before, corporations have their own tax return if they're a C corporation, but then when they distribute their earnings, their dividends to their shareholders, then those dividends are taxed again on the shareholders' tax return. So that's what they mean by double taxation. Whereas if you have a sole proprietorship or a partnership, those are considered to be flow-through entities, and they don't usually pay tax themselves. So the income flows through to the individual owner's tax return. So it's only taxed once. Government regulation can be expensive. First of all, it's not easy to set up corporations. They do have there are rules, there are laws, and you have to abide by those. So they're not the easiest way to set up a business, and they're also not the cheapest way to set up a business. So typically businesses start out as sole proprietorships or partnerships, and then as they need that additional capital, they will become a corporation, typically, although some businesses start out as corporations from the very beginning. So now let's just talk a little bit about what is involved in stockholders' equity. So we have, you've talked to some about stockholders' equity when you took Principles 1, but now we're going to get into a lot more of the details about stock itself and what each different type of stock actually means. So when the corporation initially files for their articles of incorporation in the state where they're organized, then that state is going to authorize them to be a corporation and allow them to operate. And within those articles of incorporation are a set of bylaws, which is going to have the rules and procedures that the corporation is going to follow. And one of the things that the corporate charter identifies is the number of shares that the corporation may be allowed to issue. So authorized stock is the total amount of stock or the maximum amount of stock, shares of stock that the corporation will be able to issue over its lifetime. So authorized stock can be issued or unissued stock. So issued stock just means that it has been sold at one point in time. Now, it could be that it's in the hands of the shareholders, which is what we call outstanding stock, or it can be held by the corporation itself, and it's called treasury stock, which we will talk about later on. So think of it like this. Authorized stock is just all of the stock that the corporation could ever issue. Issued stock is the stock that has been issued at some time by the corporation, and outstanding shares are those that are still in the hands of the shareholders. Now, what do we have to evidence the ownership of stock? Well, you should have a stock certificate, and it's usually a piece of paper, but most of the time we don't see that piece of paper if we own shares of stock. It's all done now mostly electronically. So capital stock is going to represent the stockholders' ownership. So each share of stock is evidence of one part of ownership in the corporation. Now, what does that share of stock allow a stockholder to do? There are four basic rights that most shares of stock will allow a shareholder to do. But you also need to be aware that some of these rights can be voted on for the shareholders to give up. So even though these four are the most common, doesn't mean that every share of stock that's sold will have all of these rights. So the first basic right normally is that each share of basic ownership in the corporation carries a vote. And that vote, again, like I said before, allows the shareholder to vote their shares at any stockholders meetings, and typically you'll be voting on things like who the board of directors are, or changes in the corporate bylaws, big things like that. So if you have one share of stock, you get one vote. But if you have 10,000 shares of stock, you get 10,000 votes. So of course, the more votes you have, the more say you have in how the corporation operates, and that becomes very important, and we'll discuss that in more detail later on. So another right that shareholders have is to get a proportionate part of any dividends that are declared and paid. So again, if you own one share of stock and the corporation declares a 50-cent dividend on every share of stock, you're only going to get 50 cents. But the more shares you own, then you multiply those number of shares times the dividend per share, so you get more dividends. So the fairness comes in that each share of stock gets the same amount of dividends, and you get more as you own more shares. Also, you have rights upon liquidation. So what does this mean? It just means that if a corporation decides to liquidate or close down, they'll sell all their assets, pay off all their debts, and then whatever is left, the shareholders will receive their proportionate share based on the amount of shares that they own. So again, you would just divide up the amount that is left after it has liquidated and divide it up among the shareholders based on their ownership interest. The other thing is that shares of stock can carry what is called the preemptive right. So we can already tell that ownership, or the percentage of ownership, has benefits. So if you were a 50% owner in a corporation, you would want to maintain that 50% ownership. So if the corporation issues additional shares, the existing shareholders have a right to buy their proportionate share of any new issues that the corporation does, so that they can maintain their ownership percentage. So if a 50% owner, if a corporation issued an additional 1,000 shares, a 50% owner would have the right to buy 500 of those shares before they're sold to anyone else. So now we're going to talk a little bit about the different classes of stock. So Most people are familiar with common stock because common stock is what is normally traded on the stock exchanges, and it represents that basic ownership. So what we just talked about, those four rights, are what common shareholders normally have. But corporations occasionally will offer a different type of stock that's called preferred stock. So as the word said, preferred stock is preferred or preferential over common stock in certain respects. So one of the preferences that preferred stock can have is dividends. So the preferred shareholders would receive their dividends before the common stockholders would receive theirs. Also, preferred shareholders typically will have preference over assets if a corporation liquidates. Also, shares of stock can either carry what we call a par value, or they can be no par stock. So what is par value? It's just an arbitrary amount that is assigned to each share of stock. So it's companies set that par value. It's usually set very low because they don't want to issue their stock below par. So some corporations, just because they don't want to issue their shares of stock below par, will actually issue their stock with no par on it at all. And this has to do with the state laws regarding what we call legal capital. So legal capital would be the par value times the number of shares, and you can't issue dividends for out of legal capital. Now some corporations, since if they issue no par stock, will actually assign what they call a stated value. So it's just, again, an arbitrary amount that's assigned, and it's similar to the par value, but it's just the corporation just will say that they're giving a stated value to a particular share of stock. And these par value and stated value will make more sense when we get into recording journal entries for sales of shares of stock later on. So when we talk about stockholders' equity, we usually divide it into two basic parts. So we have what we call paid-in capital, and then we have retained earnings. So again, part of the reason we do this is because of what we talked about before about legal capital. So state laws do require that you separate your stockholders' equity, because legal capital you cannot issue dividends from. So the two parts of paid-in capital are going to be the amounts that the company received from the shareholders when they sold their stock. So the par value, as we talked about before, will normally be assigned to common stock, which is legal capital, and anything that the corporation gets in excess of par when they sell the shares is what we call paid-in capital, in addition, or additional paid-in capital. And again, we will talk about that when we actually do some journal entries. Now, retained earnings is going to be the amount that the corporation has earned through its operations when they're profitable, that they didn't distribute to the shareholders through dividends. So retained earnings is not paid-in capital, but is internally generated equity when the corporation decides to retain some of their net income so they can use it either for future operations or to expand. And retained earnings is available for dividends, but some corporations actually never issue dividends. They retain all of their earnings. So that is the conclusion of the presentation for Learning Objective 13.1.